now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to The Real Investment Show. It is, of course, the second best day of the week as we get ready to wrap it up and head into the last week of March. Yep, April Fools next Friday. So we're going to see how this all goes. A couple of things to be thinking about here, of course. Market's been rallying here over the last few days, and that's been a kind of a nice relief after so much kind of pressure on markets over the first couple of months. This rally's been a very nice relief rally. And what's interesting is that if you take a look at a lot of the kind of the more speculative areas of the markets, the meme stocks like AMC, GameStop, Bitcoin, the cryptocurrencies, those have all been under a lot of pressure along with the markets earlier this year. In fact, those stocks are down markedly from their peaks. And of course, this is those kind of speculative areas of the markets where a lot of gambling really was taking place. And it's interesting here, over these last few days, there's been very sharp rallies in Bitcoin, GameStop, AMC, etc. And again, just goes to show that the speculative appetite of the market has not been extinguished by any stretch of the imagination. So despite the fact we've had this big correction, the bullish appetite for stocks is still there. And this is really, again, this is despite the fact that we have the Fed hiking interest rates. This is despite the fact that we've got slower earnings estimates that are out there as well, and that's lifting up forward valuations. So again, despite the fact we've had this big correction and there's been angst over the war in the Ukraine, what's going on here politically in the United States, etc., all those kind of pressures and concerns really got alleviated very quickly over just a very small rally, just a reflexive rally in the markets. And this kind of reflexive rally, of course, is what we had been talking about really ever since the beginning of the month. We were talking as we came into March, and we had a very difficult January, a very difficult February. We said when you have two negative down months in a row, you typically have a reflexive rally in the markets. And this is just because you get a lot of the selling, it gets exhausted, right? And all the sellers have sold and the buyers don't want to buy. And the markets just get to a point to where you're going to get a reflexive rally. It doesn't take a lot of buying to lift prices. And that's what we've seen here. Sentiment got extremely negative. If you took a look at the number of investors that were bullish versus bearish, the bears were grossly outweighing the bulls. That type of environment where you have very negative sentiment is actually bullish. It's a contrarian indicator. In fact, you've got so many people, it's kind of the fact you've got so many people on one side of the boat that it doesn't take a lot to move the boat in the other direction. Also, equity positioning had gotten extremely light. Been a lot of selling in portfolios, so fund managers were holding a lot of cash. That had to get put back to work. And that brings up an important point as we head into next week. Next week is the end of the quarter, which means that all these mutual fund managers, pension funds, hedge funds, all that, they have to rebalance their portfolios for the end of the quarter reporting. So there's a real potential here that some of this buying here has been part of that rebalancing process heading into the end of the quarter. But there's a real probability here, because positioning remains very light, that you're going to get a continued kind of push in buying here over the next week as we wrap up the quarter. Now, once we get into the next quarter, that's a different story, but there's certainly a potential here for more lift in markets. Now, that's kind of the fundamental side, just talking about where we are position-wise and the potential for buying because of the end of the quarter rebalancing. But having said that, yesterday, the markets did rally, and on Monday, markets rallied, and we got back above the 200-day moving average. Yesterday, we did slip slightly below that moving average. Now, again, right below that 200-day is the 50-day moving average, so there's a lot of support right here. And again, we'd had a rally, a 5-day rally right in a row, so a day of a pullback, not surprising. This morning, futures are pointing up. We're going to look like we're going to try to rally back above that 200-day moving average today. And again, we talked about that yesterday, that very likely we're going to kind of get a little bit of sloppy trading here as we've gotten this big rally and we've gotten back above important resistance levels. But, right now we are on a short-term sell signal as well. So again, it's suggesting here we have some sloppy trading over the next, couple of days, today, tomorrow, wrap up the week. As long as markets really don't fall back below the 50-day moving average, as long as they kind of hang in here for the next couple of days, that sets the markets up for a rally, potentially a bit higher next week, again, as we kind of get into that quarter end rebalancing. Now, beyond that, I really have no idea. Once we get into next quarter, all bets are off. Right now, Mary Daly and a lot of the other Fed members, and in fact, expectations by the Fed Fund futures market is suggesting the Fed will hike rates by 50 basis points at the May meeting, right? So a stronger rate hike as we get into the next meeting. Now that will move the Fed funds rate to 75 basis points, so 0.75%. And of course, the Fed is expected to hike rates 6 to 7 times this year. So again, with the number of meetings that are left, that suggests also that we'll have a second meeting somewhere down the road with another 50 basis point hike if they're going to comply with their schedule. Now, there's a lot of reasons to suspect they won't be able to. First of all, can the economy withstand higher interest rates? More importantly, the Fed is talking about starting to reduce their balance sheet purchases over the course of the next year, right? Starting potentially in May, they'll announce a schedule to start actually reducing the size of their balance sheet by up to about $1 trillion overall. So again, can the markets, can the economy withstand less monetary accommodation? Historically speaking, really since 2009, the answer has been no. Every time the Fed has contracted their monetary policy, 2010, 2012, 2014, 15, 16, 2018, whenever the Fed has been either reducing monetary accommodation or have been constricting or tightening monetary policy, the markets have not responded well, the economy has slowed, and we've headed towards a recessionary break, and the Fed's had to back that up, start lowering interest rates, start monetary accommodation again. So will this time be different? Probably not. But that's kind of history kind of playing out. But there's a lot of expectations, as always, that this time will be different, and what happened before won't happen this time because of a reason that's one thing or another. And that's kind of, to the yield curve. I've got an article coming out next week talking about the yield curve, because already as we get, yield curves approaching zero and potentially inverting here, there's already articles out saying, well, this time is different because the Fed is manipulating the yield curve. Well, that was the same case in 2019. In September of 2019, we had a yield curve inversion, and the excuse was, hey, the Fed's inverting the yield curve on their own. This has nothing to do with the economy. The economy is very strong. And then in March of 2020, you have a recession. So, can the bond market predict the pandemic? No. But what the bond market can predict is saying that there are certain pressures in the economy that set the economy up for trouble if an exogenous event comes along that impacts economic growth or consumption. That was the pandemic. So so the question becomes, if the economy is really strong, and if the economy was really, really growing at the rate that we thought it was, and it was sufficiently funded, would the pandemic have created such a deep recession? See, that's the real question. We don't know the answer to that. We never will. But the point is that the bond market always knows what's going on. And what the bond market's telling you is that the economy is a whole lot weaker than it looks at the surface. Be right back after the break. We'll pick up with Michael Leibowitz, talk more about the Fed hiking rates at the next meeting. What does that mean for the economy and the markets? Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
There's a war being waged on your retirement dollars, and unless you act now, you'll lose the battle with inflation, higher taxes, and a lower standard of living. You can blunt the effects of rising prices with our next workshop on combating inflation in retirement. April 2nd at the Embassy Suites, Houston. Richard Rosso and Danny Ratliff will help you fortify your life savings, make the most of Social Security, and lower your taxes. Register now for this free workshop at realinvestmentadvice.com. Combating inflation in retirement with Ratliff and Rosso. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. Of course, it is Thursday as we get ready to wrap up the week. Thank goodness. It's just been a week already. Couple of things to get into. Of course, today the Fed is talking about hiking rates, and Mary Daly out actually this morning on Bloomberg suggesting that the Fed needs to hike rates by 50 basis points to, kind of combat inflation. Then, of course, at the same time, we've got Congress talking about needing to send direct checks to households in order to combat inflation. And this is really two very kind of interesting points because they actually are a function of each other. But, let's start with just kind of talking about where we are. Again, the Fed is in a process here of needing to combat inflation. And Michael Leibowitz and I have had this discussion. There's